Hey, it's Richard with Matthews Wealth Management. We're going to do the July recap market update. Pretty numbers intensive, but we're going to also go through some key topics. I'm going to try to keep these shorter again. It got away from me for the month of June. So anyway, one of the biggest differences that we're seeing for July, it's kind of a continuation of that rotation back over to growth. You see it more so over here in the mids and small caps. Small caps across the boards got absolutely hammered for the month of July. Mid cap value also fell off. Large value managed to get a little bit of a gain, but still we see the majority of gains going into the growth areas of everything except small cap. Emerging markets are falling off compared to international, and there's a reason for that. Our play back in February to go towards tips and long terms has definitely paid off. That's where we want to be in the bond market. We're starting to think through when we might rotate again in that area of fixed income. High yield bonds are starting to deteriorate on their returns, and so that risk reward might be worth shifting a little bit on our next rebalance reallocation. Real estate is in the news right now. CDC just issued another moratorium on evictions and foreclosures, and Supreme Court obviously had ruled that unconstitutional. How that plays off is going to have a lot to do with the timing of real estate continuing its growth. As you recall, we're very short on real estate there. Oil is continuing its gain. Gold actually bumped up, which was nice to see. We're seeing gold-silver ratios kind of start to normalize. Silver's still pretty far ahead from what we saw pre-COVID. S&P in the last month up 2.4. Moderate's only 0.5%, so we're seeing a big disconnect there, and a lot of that has to do with the valuation on the value side of equities as well as the small caps, and then the short-term intermediate terms. That's what's weighing down the moderates. If we look on the quarterly, it looks almost like a repeat, honestly, of everything there, except oil, we're at the 17.66% rate of return. So commodities was a big push of what we did back in February for kind of a reflationary type hedge, and we're seeing that play out here. Jumping into year to date, just huge numbers in equities. They've kind of normalized. You can see growth is taking off here in the world of large cap, but it's not in mid and smalls. In fact, small cap growth is barely positive year to date, whereas its value side is 24, almost 25%. So we're very happy with those moves that we've made. We've seen a little bit of a reshuffle in June and July as far as large growth and kind of its overall push. And a lot of that has to do with where's capital best invested right now, and growth has the biggest upside. So it's just the free money push. If you see oil here up 54% year to date, real estate, I was not feeling confident enough to stay in that investment, but it's had a great return year to date, as well as S&P is up 18% and a moderate portfolio just under 8, or under half of that. So you can see how a lot of these non-traditional asset classes are offsetting the S&P gains versus a 50-50 type portfolio. So let's jump into key topics again, trying to keep this short. There's a lot of key topics actually to consider. Large cap growth has a substantial amount of gamma, which is basically just a ratio of options to shares being traded. That was one of the big pushes that we saw with the Reddit people that were going after GameStop and AMC and all of that, was they were maximizing the effect of gamma. Well, we're seeing that now in just large cap growth or the tech stocks. So pay attention to that. Immunity, shutdowns, masks, that whole thing. CDC stopping the moratorium, Delta variant. I think Lambda was mentioned today. One of the things that's not discussed is natural immunity. People who've been infected and recovered and produced antibodies and T cells versus those on the vaccine. And there are a few studies out there that are starting to highlight that, and the fact that natural immunities carry much better defense against reinfection and future infections, as well as severity of hospitalizations, deaths, etc. It'll be in the newsletter, one of the links, so I'll have some of those studies out there. Let's see, Amazon is going to be exempted from the global minimum corporate tax if Janet Yellen gets her way. That's very strange. In fact, when we start diving into more of this, unemployment seems like Amazon's going to be a major employer here. So look at how all these things play into Amazon and the investment opportunity there, or risk. So Amazon being exempted is just very strange. Looks to be I'll leave it at that. I don't want to dive into it. People in Chicago that are unemployed, single with 2 kids, are pocketing $51,000 per year in unemployment and benefits. So why would you go back to work, right? Especially if you were making only $40,000 a year. We've got a little bit of a offset as far as what we're trying to get people to do and saying that we want to do, and a lot of that's just public policy. So very interesting to see that number. As we're doing stimulus, as we're talking about potential shutdowns and printing more money and keeping unemployment going and keeping rent assistance going, we're creating demand, right? That's the whole concept of loose fiscal policy, as well as stimulating the economy. It's all based on aggregate demand. It's a Keynesian theory, but it's at the expense of productive capital. And that's what we were seeing pre-June, is productive capital was seeing as a good investment, the value parts of the economy and equities specifically. So productive capital, how money makes money and makes goods, is just kind of the back of everybody's mind. Nobody's talking about it, and instead we're just boosting consumption. Consumption and aggregate demand is one side of it, but if we're chasing after fewer goods and services, then it just creates inflation. And that's, as you know, where I go. 150 million people have left the middle class in COVID. That's like half of the population, and that has to do with inflation, and it has to do with unemployment. Bloomberg, of all places, that's a fairly Biden-supportive publication. They're the ones that did this report, so that'll be also in the newsletter links. So very interesting that we've lost 150 million out of the middle class here. Tracking M2 money supply, as we always do. This was an interesting month. We didn't print hardly any money. That's 0.083% increase. I think we were at 20,190,000,000,000 or something in the month of June. Now we're only 20,388,000,000,000 dollars floating around in M2, and that's great. That's the first time we've seen that kind of fall off. Wonder if that's because some of the states discontinued their unemployment assistance or accepting the federal dollars. That's potential, but it was very interesting to see a flat line on the growth of money supply. Year to date, we're still at 5%. Think of this as inflation. In the last year, 12%. Since pre-pandemic, 32%. So that, I think that was like 15.5 trillion is what we had back then. Now it's 20.4 trillion. So a lot more inflation, but it's tapering. How that pans out with more shutdowns and COVID and unemployment and Amazon, it's going to be an interesting month of August. So come back and see us next time.